Good morning, Propenomix people, and welcome to another Propenomix Live. This week's was entitled Be Careful What You Wish For, and you'll find out why. So if you've listened before, you'll know I like to start with a quote. And this week's was Be Careful What You Wish For, You Might Just Get It. And that has its origins in Aesop's fables. So this quote is about caution and consequences, and you'll see just why in the deep dive. But before we go into this week full throttle, Rod Turner and I delivered another great property business workshop in the past week on mergers and acquisitions and joint ventures. We had fantastic feedback from the attendees, which we are most grateful for. Our next workshop, and the last one of 2025, will be held on Wednesday, the 1st of October in London. The subject matter this time is investment, with an emphasis on what metrics you really need to be considering to run your property businesses properly and building your business to scale. How have we done so many deals? Well, we'll tell you. Save the date. The workshop is not online just yet, but it's Wednesday, the 1st of October. We also have a space at the moment in our boardroom club, which is designed to help SME property businesses to scale to the next level. We're looking for existing investors and developers who commit 20 or more hours per week to their property businesses. And I'm very happy to have a no obligation chat about the club if you just leave me a comment or send me a direct message. Or tag anyone else you know who you think might benefit from joining the club. So, on to the main meat of the subject matter, starting with Trumpwatch. The overall procession continued, inching away from traditional US democracy day by day, with everyone being too scared to say anything, as the big, beautiful bill was ceremonially signed on the 4th of July alongside more military flyovers. Extra defence spending is about the least controversial part of the bill. Permanent tax cuts and 1,000% increases in immigration enforcement upset far more people. Let's not forget, there's still no deferral yet on now what's just a couple of days away, the tariff 90-day period, in which 100 deals were going to be negotiated, if you remember. And the closer we get to that deadline, the worse or weaker another deferral looks. So is it time to call the second bluff in a couple of weeks? Well, Trump's quest for the Peace Prize continues as well, putting forward a 60-day mediated ceasefire. In terms of his efforts to end wars, I do feel they come across as particularly genuine, with an opportunistic tilt, let's face it, if that door is open. There's also a visit in the diary for his favourite Scotland, with golf being the main item on the agenda. Now, from the yield curve perspective, yields were on the rise just a little in the US in the past week, which never really offers a positive backdrop. And you'll see as this whole piece unfolds that a positive backdrop would have been helpful in the UK this week. Before the Independence Day holiday, positions started to be open, preparing for tariff-induced volatility. My biggest fear is Trump really believes that if you put interest rates down as the Federal Reserve, so you put the base rate down, then regardless of anything else, bond yields will fall. He completely misses the nuance that if there's no confidence in the ability of the chair or the entire Federal Reserve to manage the short-term lending rate responsibly, then bonds crashing and yields rising is a very live possibility. And it certainly seems to be fire that he's playing with and he's willing to play with at the moment. Instead, he just tweets to Jay Powell telling him the base rate should be 1%. If it was, the yields on longer-term bonds would go nuts, upwards, affecting, amongst other things, the mortgage market. At the very best, it kicks the can down the road. So perhaps Mr. Trump does understand all this and just wants good interest rates for his presidency and hang the long-term consequences. But this wouldn't be good for and wouldn't please the people. So let's get to our subject matter, the real-time UK property market. Chris Watkins delivers with the reliability of Amazon. Week 25 has now been reported on. Listings printed 36,700. No material change on last week's 37,700. We're still 5% higher than 2024 year to date and 7.6% higher than the pre-pandemic market. But my ready reckoner of 10% more stock than a normal market is clinging on by its fingernails. We're 14.9% ahead of the 9-year average, but that does include 2020's listing figures, which pollutes the figures somewhat. We've inched back towards the mean over the past couple of weeks, meaning that week by week, we are listing less than the historical averages for those very recent weeks in isolation. 26,700 price reductions, 14% of stock reduced in May, compares to last year's 12.1, April 2025's 13.4, and the 5-year average of 10.6. So more stock, more reductions, both absolutely and relatively. 32% more reductions than the 5-year average. That's the difference between 14% and 10.6%. So 25% more reduced properties than a normal market also works as a ready reckoner. 1 in 7 properties on the market are being reduced each month. So we're currently running at a little over 100,000 price reductions per month, to be clear. You're saying you can't find a deal? Have a word. 27,500 homes sold subject to contract, which is still healthy. SSTCs are up 8% year on year and 15.6% on 2017 to 19, and still nearly keeping pace with 2022, which to this point was a very hot market indeed. We went into June with 756,675 homes on the market. As the market got stickier before the pandemic, that number was 660,000. A seller's market is more likely to be under 600,000. At the end of May 2024, 694,000 were on the market. It's a lumpy trend upwards in just May, and with this amount of stock on the market, it will be continually hard for prices to surge forward in the coming months. The flat feeling will likely manifest in a steady market without much excitement as we head into summer proper. The first month which sees fewer on the market that isn't November or December would be a tell that this glut of stock, which must be being provided at least in part by exiting landlords, the never spoken about truth of this current market, has reached its peak, but there's no guarantee that we're there yet. Fall throughs are staying below the 7-year average, 23.7%. Last week it was 23.2%. The average is just under 25, 24.2. Relatively normal noise, really. The net sales are still playing ball with 6% up on last year, 11.1% higher than 2017 to 19. So it's fair to say that demand is actually higher than in all of those years, not at 2022 levels, but the stamp cliff will have also forced a few more transactions out of bed, of course. So while the gross sales are close, the net sales are not so close. And as the year progresses, then in absence of any more shocks, I think we'll catch up and then surpass 2022's figures because, of course, let's not forget they were significantly disturbed in the last quarter by that 2022 budget and what happened to the bond markets as a result of that budget. Now, I always give Chris a weekly shout out here because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with great stats on a regular basis. Drop him a like, a subscribe, and all the rest of it. And make sure to follow him and drop him some kind words for his content creation as well. He really does do a service to the industry. If you're in the industry and you want some support in growing your business or to be a more effective communicator and be more in touch with your local market, because that's his core business, give him a shout. His article gets published on the Property Industry Eye website, and the video goes on his YouTube channel, which is at Christopher Watkin. Okay, here comes this week's dose of macro aggression. We had the Bank of England Money and Credit Report, which is always important to analyse. The nationwide house price index caused a fuss, and let's look at the justification or not behind that. The finalised PMIs were out, including construction, so let's look at the more detailed update on the flash reports I reported on last week. Largely good news on that front, by the way. And then we've had a week that reminds us all why we keep an eye on the gilt yields. So the Money and Credit Report, net borrowing back to something that looked like normal, 2.1 billion for the month of May. After the stamp duty distortion, we had huge net borrowing in March, over 10 billion, massive figure for the month. Then we had negative net borrowing in April, aka there were more mortgages paid back net overall than there were monies taken out. So we kind of have to ignore those 2 months, at best average them, although it's not necessarily that the stamp frenzy started on the 1st of March and ended on the 30th of April either. So we do need to be cautious with these figures near a relatively seismic change in the market compared to the normal day-to-day, week-to-week, month-to-month market that we'll come to expect. Net mortgage approvals were still over the 60,000 mark and are heading back towards the 65,000 mark, a sign of a particularly healthy market. We printed 63k. Remortgages were up to 41,500, which is a really significant increase. Perhaps many who had waited and felt the flip-flop of the tariffs and other global impacts on yields decided to wait no longer. We haven't had a number over 40k for about 2.5 years on remortgages. So milder May saw less than half the expansion in individual consumer credit expansion compared to that awful April as well. So the pain of that month subsided somewhat. The money supply also moved upwards again by around 0.2%, but only to just above where we were in September and October 2022. The pace upwards has picked up slightly, though, which again is not necessarily conducive to a 2% inflation target. The drawn rate, which I like to watch closely, the rate at which the average mortgage was drawn down, was 4.47% in May. And the stock of outstanding debt now stands at 3.87%. So that convergence is continuing, but very slowly, just several basis points per month. And at the point where these lines cross, we know rates are on a downward trajectory, if we do. And also we have final confirmation the housing market has totally absorbed the transition away from the days of cheap debt. And that will be a red letter day in the calendar. We're 80% through the cycle now, or 65, 70% at least. But it'd still be nice to know we've really absorbed the cheap money days. They're in the history books. Fair enough. It was what it was. I hope you made money out of it while it was there. But the market has largely adjusted. So that still looks like that'll be around the end of 2026 at this current pace of change. Drops in rates that aren't leading to much in terms of lower 5-year gilt and swap yields, which are the majority driver of the mortgage market. Although 2 years are much more palatable once again, the cost associated with those 2-year mortgages is drastically increased, of course, on what it was pre-COVID inflation days. Overdrafts come in at 22.28%. Credit cards at 21.54% and personal loans at 8.72% on average, if you're interested. SMEs nearly borrowed more than they did a year ago, which is a phenomenon that hasn't happened since August 2022. But the growth rate of SME lending was still minus 0.2% year on year. Large businesses, however, really pressed on with borrowing at an annual increase of 8.4% year on year, which is huge. The larger companies paid 5.6%. It does sound like a very large loan, might have distorted the figures here, but the Bank of England don't go into further detail, versus 6.54% to SMEs. But either way, those numbers are a significant reduction on April's numbers in terms of the cost of debt. Time deposits for individuals in May attracted an average of 3.92%. So that would be your 5-year fixed rate savings account at a potential provider. Whereas instant access, or sight deposits as they're known, were 1.96 on average. So they're back under that 2% mark for instant access on funds, or losing money to inflation. And let's face it, the time deposits are losing money to inflation once you've taken tax into account if you're a taxpayer. So June's figures will be interesting given what the Nationwide had to say about June, but we've got to wait one more month for June's figures when it comes to the money and credit report. So in relative isolation, May looked like a return to normal for the housing market after the stamp changes that came in on the 1st of April as far as the credit conditions were concerned. So onto the Nationwide, because it was the end of a quarter and a half, and we got regional and national HPIs from them this month. But the figure that caused the fuss was their monthly print of prices down 0.8%, biggest drop in 2.5 years, etc., depending on just how much you love to sell that in your newspaper. It made bigger and bigger headlines. That put annual price growth down to 2.1%. Nationwide's chief economist didn't have much specifically to say about this. Instead, he just blamed stamp duty for the noise, front-loading transactions, perfectly reasonable interpretation, and said they expect activity to pick up as the summer progresses, which is very much what's going on if you listen to analysis from places like Zoopla, who are usually pretty level-headed in these situations, mostly thanks to their level-headed director of research, Richard Donnell. They pointed to the usual cocktail: low unemployment, earnings rising healthily above inflation, household balance sheets are strong, and borrowing costs are likely to moderate a little if bank rate is lowered further in the coming quarters, as they expect. Now, that seems to be on there every month as a bit of a cut and paste job, to be honest. And that looked really, really nailed on until this week came along. But more on that a little bit later and in the deep dive. Nationwide also point to a narrowing in the north-south divide, because Northern England is only up 3.1% year on year, including the Midlands, versus Southern England at 2.2%, which includes East Anglia. One point I'm keen not to gloss over is the performance of flats versus houses, which is lost in all of these figures and wasn't in the headlines that anyone chose to report on from this Nationwide report. Nationwide has flats up 0.3% this year versus semi-detached at 3.3%, detached at 3.2%, and terraces up 3.6%. So house price growth is a bad piece of wording at this time. Property price growth is 2.9%. They don't really distinguish as to why their annual percentage change is listed at 2.9%, but their annual change is 2.1%. You wouldn't think they would be that different, but data integrity and transparency are not the strong points of this Nationwide index, I'm afraid. Houses are up closer to 3.5%, according to Nationwide. Only Wales lags behind England of the devolved nations, according to Nationwide, at 2.6%. Scotland printed 4.5 and Northern Ireland rocks on at 9.7% year on year. And if we pass even further regionally, the North printed 5.5%, with London lagging at 1.4 and East Anglia even further behind at 1.1. On a quarterly basis with no fanfare at all, Nationwide also updates their quarterly real house price table. Now, you have to go to such an effort these days, you have to Google it to find an Excel file. So it's only an if you know sort of piece of info. But I've been watching it for many years now. They adjust for RPI rather than CPI, the retail price index. But of course, this is because they tend to go back about 50 years in this time series. And so there wasn't CPI before the 1990s. It was a new construct around then, statistically. Now, they also run an upward trending line over time, which I actually happen to disagree with these days, noting that the growth in the past 20 years has basically only been at RPI level. So I see the trend line as much more flat than I do increasing, as the Nationwide would argue. But this real house price looked to have bottomed. I first identified this 2 years ago, around about this time of year, in a supplement that house prices were the cheapest for 20 years. When you looked in real terms and adjusted for wages. However, because of their negative June print, we found a lower low in that time series. And so we're now once again at the cheapest point in inflation-adjusted house prices for 22 years. Let that sink in. All the nonsense and all the noise from the media ebb away. So I should say, sorry, that is inflation-adjusted. We're back to Q2 2013, which was the low, which obviously 12 years ago. But wage inflation-adjusted, we're at the cheapest for 22 years now. So ignore all that rubbish noise and nonsense in the media about unaffordability propagated by so many of the large economic commentators who just do not look at the fact or are highly influenced by the place in the country they happen to live, which happens to be lovely, and those house prices have outperformed there. You know, London, you could say, take this. This doesn't apply to London, does it? Well, no, it doesn't quite. But actually, if you look at how London prices have performed since about 2015, 2016, you'll see how much they've drastically actually underperformed a lot of other areas of the country now. So this is why you have to look at the source data, right? This insane imbalance between supply and demand has only worsened in that period for potential buyers. We know that. That's got worse. So at the end of quarter 2, 2013, the average nationwide house price was £167,294 in nominal terms, whereas it's now £272,751. Sounds like a huge difference, of course, but doesn't even keep up with RPI inflation. So if you're investing in something for the long term, do you want to buy at historically low prices, medium prices, or high prices? We all know the adage, buy low, sell high, a great mantra. Easy to say, not so easy to do. However, we also know that many are not cut out to buy low if they think prices might continue to go down. And in real terms, they might. Right now, looking just at the next quarter, we've got house price below 3.5% growth annualized. I'm pretty sure about that, right? Notwithstanding the noise about stamp duty adjustments. And then we've got inflation at 3.5 or more. So especially when it comes to RPI, which tends to be higher than CPI, I'm only saying CPI will be 3.5 or more over the next quarter. Can we time the exact bottom? Well, it's an utter fool's errand, even in a stock market where you can buy and sell shares very, very quickly. Buying a house is not a fast process. So the opportunity lasts for quarters and years, in fact, out until possibly 2030 or so, as I see it. Although as headlines pick up on faster house price growth in 2026 and beyond, more investment money will come into the market. And as I've detailed last week, when I went into significant detail about the changes in mortgage regulations, apart from anything else, and what's been already done and what's actually on the table to happen, we are expecting house price growth to start outperforming wages and inflation over the next 3 years. Not within the next 3 months, but certainly within the next 3 years, significantly, which will be handy for the next election, won't it, Labour Party? Isn't that clever? So that's nationwide ticked off anyway. What about the PMIs? Regular listeners will know I love the PMIs as real-time flash indicators of the economy. Things improved a little bit on the flash numbers as reported last week, but got an extremely positive write-up. Well, perhaps they knew something last week because the final print was so much better than the flash write-up, which is quite rare because it's only a week between the two releases. But the flash composite PMI was 50.7. but the final print was 52, which is not up to the long run average of 53.3. We feel really good and healthy when we're printing 53s overall, but largely speaking, that was pretty much dragged back by everything other than services. Services are driving things forward, and they printed 52.8. The flash services estimate was 51.3. So services are driving things forward, although they're still being held back, according to the report, by exports, which we'll see. So you can see the services at 52.8, a long way ahead of the composite. So that means, by definition, manufacturing and construction are likely lagging behind. Manufacturing printed 47.7, which is the same as the flash number. Construction hit 48.8. Now, look, it's an improving slope back towards 50.0, but under 50 is still contraction territory, and that's 6 months in a row. But house building activity is finally rising, and that printed 50.7 in its own mini index, so it just got its nose in front of par, whereas civils and commercial work are both falling and printed 44.2 and 45.1 respectively. This was the first time house building was ahead of the 50 spot since September 2024, although that commercial activity print was the sharpest drop in just over 5 years. So what took the credit? Well, more stable demand conditions, which makes sense, although Nationwide have obviously upset the apple cart with their price index for the month. And business activity expectations dropped to a 2.5-year low, unfortunately. So overall, it was the best print for 6 months, but there looks like to be a bearish 12 months ahead for construction. House building sounds like it will be doing the legwork after a period of shrinkage, which basically correlates with the Liz Truss budget of 2022. The manufacturing PMI was on the other side of optimism, though. Whilst things you don't want to be falling, production, new orders and employment all did fall, they fell at slower rates. Orders to inventory, seen as a leading indicator of future production trends, climbed to its highest since August 2024. Inflation softened. Business optimism was at a 4-month high. You could see this month's print as perhaps the first of a world that's adjusted to the employer's NI shock. Services with that healthy-looking print were full of more bullish headlines. The fastest rate of service sector growth for 10 months. New orders rising for the first time in 3 months. Yes, staffing was down yet again, so it remains a concern, but prices charged inflation was the lowest since February 2021. The economics director was a little more cautious, a modest rebound in service sector growth, thanks to a turnaround in domestic business and consumer spending, is how he reported it. The Q1 data, which was released this week on savings, did indeed back that up. The first fall in the savings ratio in over 2 years, from 12% to 10.9%. What's been blamed is higher living costs, although that seems strange that given the rate of inflation over the past 2 years has calmed down quite a lot. So I'm not really sure that supports the facts. That ratio is still really historically high and still more than double what it was before the pandemic. So I just think that's a little bit refusing to get too political in the PMI report, to be honest. The savings rate is high, not because the returns are so great. As I said, instant access is now returning under 2%. The savings rate is high because people are worried, and they're worried about future tax increases, and they're worried this Labour government isn't doing a good enough job. That's my personal opinion and take on those figures. But of course, I can say that, and the S&P economics director cannot. So what does he say in the rest of his report? Exports are still an issue, hurting service sector growth, headwinds from tariff uncertainty and geopolitical tensions, of course, being mentioned. Although if you trust the markets, that's kind of blown over at this point. This was the 9th month of employment shrinking in the private sector, according to respondents, with hiring freezes and the non-replacement of redundancies and voluntary leavers being the reality on the ground. Now, it's not something I talk about the difference between too often, because we tend to talk at a macro level about employment, unemployment, and then inactivity. Those are the 3 distinctions that I talk about on a monthly basis when we look at the employment figures. But what we could also talk about is public sector employment and private sector employment, and the drag that tends to have on productivity. And public sector employment is right back up to where some of the highest it's been over time. And that is ultimately dragging on productivity because public sector workers are not as productive in the way that productivity is measured. This is not a value judgment statement. This is just a factual statement. Public sector workers are not, generally speaking, as productive as private sector workers. So overall productivity goes down as private sector employment comes downwards because the private sector is cutting people, cutting growth plans, worrying about even more tax rises in October now that the welfare bill has been defeated in the Commons, and we'll come on to that later on, but it is again damaging for business. Business is again now going to sit and wait until the budget, realistically, for a lot of stuff. So that kind of craters July, August, September and October, they will not go full pelt unless we're going to see an announcement over the coming weeks where Rachel Reeves and or Keir Starmer come out and say, we are not going to tax businesses any more than we already had. Businesses have shouldered the burden. What that then sends out, of course, is that therefore it's going to go to the consumers or the people, and therefore the manifesto. If you don't already consider the we will not raise taxes on working people commitment to be broken, then ultimately it will definitely be broken this time around, because nipping a bit from the ISAs, which looks like is absolutely a penalty kick at this stage in terms of tax-free cash savings, that is not going to cut the 5 billion a year that is now not being saved on welfare, on a spiraling welfare bill that's a tragedy of a situation. And I may well do a piece on that in the future. It's more of an interest piece than it is specifically about property, although if you've got a portfolio, you'll know you're probably housing some people who are in receipt of the personal independence payment, and every case is different, of course, and that's the difficult thing, but nobody wants to talk about it because they just want to use the very worst cases, which are the very much most deserving cases of things like this, as the reason why benefits should never be cut, which is not helpful in any way. It's just emotive. It's not data driven, which is no good for the country's finances. So the report finishes off then telling the Bank of England Monetary Policy Committee what to do, and the feeling from the PMI is that there's more than enough positive news around cost inflation for one more cut to be in there from August. Just 1 week ago, it was penalty kick status. But with that in mind, let's segue through to the gilts and the swaps. You might remember we crossed that magic 4% Rubicon last week on the downside on the 5-year gilt yield. And so we opened the week at 3.965 on the 5-year gilt. And then there was Wednesday, a brief spike when the vote happened on the welfare reforms in the Commons. The rebels very much felt like they had a cause, and the markets interpreted this as, we knew it, this isn't a government that's going to cut spending, they were just pretending. The yields jumped in something that looked like a trust moment, but only very briefly did it. 11:55 a.m., the yields crossed 4% on the 5-year, 4.002. They peaked at 4.155 at 1:25 p.m. There was a huge move there in 90 minutes, and indeed there was a bigger move in some of the other gilt yields, which moved up 20 basis points during the day at its peak. It's a massive move in the bond markets that are supposedly not that volatile, although they did retreat back very much so as the afternoon went on and the day afterwards. But the 5 billion that was in the mixer here was more symbolic. It's only an eighth of the size or less of the black hole that Liz Truss created, if we use Rachel Reeves' terminology, without asking, the Office of Budget Responsibility or anybody who really knew what they were doing, whether that was a good idea or not. So lots of headlines were generated, but by the end of the week, a more sensible point of view took over and dragged the 5-year yields back to close just above 4%, 4.006% to be precise. Not a week we wanted, but given the news that was absorbed by the market, definitely not a disaster. And it's often said that when the market doesn't quite react in the way that you thought it would, we didn't see this big push upwards in the yields be sustainable at all. It's very much clear at the moment the trend is downwards. Part of that will be because it's anticipating a cut at the August MPC meeting, absolutely. But to go all that way up and then drive back quite so quickly, remember in the Liz Truss moment, what we had was the Bank of England coming out and saying, don't worry, we'll buy bonds, we'll do whatever it takes in the long-dated bond market, which would be quite profitable if they were doing that at the moment, to be honest, with the yields out there, but we'll talk about that in a moment. So that Thursday close on the 5-year gilt was 3.983% yield, which corresponded across to a 3.622% 5-year swap yield, which again was 36 points below the gilt yield. That still compares favourably to 1 month ago, where it was 3.781, and 1 year ago, where it was 3.952. And the 2, 3 and 5 year swaps look very, very similarly priced, whereas the 2-year compared to the 2-year a year ago is a drastic difference because the near-term rates have fallen. And as I've stated, the yield curve has very much become a little bit more orderly and a bit flat at the front end, granted. So 3.583% on the 2-year print is comparing to 4.453 1 year ago. So nearly a whole percentage point difference in annual 2-year mortgage rates, which you will have noticed if you're looking at that sort of thing and you like to use 2-year rates. I dislike them a lot because there's an awful lot of administration, frictional costs and all the rest of it. Unless I'm thinking of selling a house after 2 years, but before 5 years, I really don't consider them at all. But that's my personal preference. How about the 30s, the 30 years? They're still under scrutiny. I promised to look at them weekly these days as well. They had a volatile Wednesday as well, but also came back. They opened the week at 5.273 and closed at 5.358. So we did see a bigger expansion in the long term, and this is how that news has been absorbed by the markets. Over 4 years, it's basically been deemed to be worth about 4 basis points over the next 5 years, over the next 30 years, it's been deemed to be worth about 8 basis points per year. So that's as big a sign as you can get that the can has been kicked down the road as far as the market interpretation has gone. So we've got this very, very steep curve going out to the 20 and 30 year points at the moment, which is saying, as I've reported on a few weeks ago, that in some years' time, interest rates will be higher than they are today. So I don't think we're going into a future with lower interest rates. The yield curve's very clear about this. But things can change, and things will change as and when there are black swans, recessions, and the likes. So I would see that market movement as a shot across the bow this week. The markets are saying, if you think you can just turn the taps on Labour, the market will absolutely revolt and the debt costs will crush what little growth the UK is generating at this time. And everyone's mortgages will cost more again. But will it be Reeves even getting to interpret this after getting her toughest time, I think it's fair to say, in the press this week? And that's why the deep dive was left with no choice. What are the near-term economic consequences of all of this? And indeed, will Reeves still be in power come October, November to deliver the budget? There's a fair few commentators who think she'll stay for that and then she'll be gone. Some think she'll be gone before that. But of course, in the days and weeks after these fairly significant events, things tend to ebb away and people have a bit more time to form an opinion. You know, it's easier for me watching this on Wednesday and then having till Sunday to formulate a sensible piece of commentary rather than having a mic thrust in front of my face, as many political and economic commentators do, and trying to say something that's correct in the heat of the moment. Very difficult. People are not good at generally being balanced in those situations from what I see. So how would this affect Starmer? Because losing chancellors isn't that easy to recover from, if you remember Liz's situation, but also there are a number of other examples of that over the years. Who are the likely replacements and what would that mean? I was left asking myself all of these questions after listening to a particular podcast that I like to consume called The Rest is Money. By no means do I agree with everything there, but both Peston and McGovern do a great job of covering what's relevant and on the day. Peston was absolutely convinced that Reeves is a goner after Wednesday. Now, I do disagree with his analysis quite a lot, or I do see some bias in it quite a lot, I should say, because he's inevitably political. It's impossible to be as close to Westminster as he is and not be, I think. But remember, The Rest is Money is pitched as an economics pod, really, not a political one, even though he's spent at least as much of his career covering politics as he has economics. He is obviously a trained economist and comes from an economic perspective or tilt. But as I say, that's the downside of having to consume the facts and then drop a podcast straight away. But he left no doubt in the listener's mind about his position. But presumably that pod was recorded just a few hours after what had happened on Wednesday had happened. But he is widely influential. He is well respected. And in fairness, he's by no means alone in that position either. I've heard plenty of other mainstream commentators say Reeves will be gone. So I thought I'd better go there and look at what's going to happen. So let's get on with it. I commented seriously on a more jokey LinkedIn post this week saying I thought Reeves was having an unnecessarily tough time. She's made the difficult decisions, Starmer has supported it, and they failed to get their parties in line. She came out very early on as a fiscal conservative, wanting the Iron Chancellor role and image, and the party has kicked sand in her face and shattered that dream. We're not having it on welfare cuts, they say. Now, there are political nuances here, such as a very well-constructed argument I did hear around how it was specific policy that was the issue here. It was badly drafted, it was hurried, and that's what some of the rebels were against, not the ideological position of welfare cuts. But I'm not sure the markets care about the nuances of all of that, and I'm not even sure that I believe it myself, to be honest. Labour governments have several characteristics time and again. Unemployment goes up. Planning gets liberalised. More money is pumped into the welfare side of the state. This is what the market, so this is what's actually happened, not what should happen and what might happen. No, I'm not talking about debt here, because apart from anything else, you'll notice the Conservative government in the US at the moment, and how much they're increasing debt by, and how much they have time and again. There's a lot of fallacies around how much the debt increases or not. And if you look at how much the Conservatives increase the national debt by, even taking over post-financial crisis, you can make your own decisions. But of course, you should also take into account COVID meant that there would be a huge amount more national debt to be taken on. So we did also need to be fair. But this is what the markets would have expected from a Labour government. And this so far is exactly what they are getting. So I think most who've listened to me in the past wouldn't necessarily expect me to come out as some kind of defender of Reeves. And I find myself in this position simply because I think the pendulum has swung too far. I also pick up some vibes of a woman isn't up to the job. Remember, we've never had a female chancellor before, although we've had 3 female prime ministers. And I think that's worth noting, because ideological bias on any side has no place in any reasonable argument. And there's no argument for misogyny, certainly. The pictures this week told 1,000 words, visibly upset because her fiscal rules are under serious pressure at this point. I think it was the tears that spooked the market, because I think the markets trust Reeves an awful lot more than they trusted Kwarteng and Truss, for example. Much more predictable. Optimistic in words, but not in body language. That's what we've seen so far after the misery of the budget was behind her. Starmer said this week, although it took him time to come out and say it, and let's face it, that Reeves will remain Chancellor for a very long time. Whilst this isn't the kiss of death that many votes of confidence mean in the world of sport or football managers, for example, it does make you think that the only way he'll get rid of her is if he's under pressure himself to go and thinks he can save himself by getting rid of her. Reeves is now the most unpopular senior politician in Britain, with 51% having an unfavourable view versus 16% having a favourable view in a poll reported this week. But in honesty, I don't see how you could be the Chancellor at times like this and expect to be anything other than pretty damn unpopular. The Westminster machine is speculating who will replace her. And this is part of her appeal, to be honest. The least worst option, at the very least. Pat McFadden's hat is in the ring. He's the bookmaker's favourite. Experience from back in the Tony Blair era. He would still fill that trusted pair of hands and retain a market-friendly approach, most of the reports think. I've heard him speak half a dozen times, and that's largely what comes across, I must say. More of a night watchman. So think a little bit like Hunt when he replaced Kwasi Kwarteng. Not that Jeremy Hunt did a bad job, in my view, but he also did have some post-COVID favourable winds behind him, which just are not there at the moment, which did make his job a bit easier. And then he slipped in that poison pill that I referred to in his budget this year, in 2024, the early budget of 2024, that made it very, very difficult for whoever was coming in to make a fist of it. And of course, Reeves decided to descend on that, come out with the black hole rhetoric and use it as a reason for raising taxes on businesses. Next in line is Darren Jones, as far as the bookies odds go. If you've ever watched Question Time or similar programs, you might have seen him come across on there. Very matter-of-fact, technocratic style, would suit the role, but I don't see him getting more party support for cuts than Reeves had. Same goes for McFadden, to be honest. Jones is just a younger version, a symbolic change of energy. But, Reeves is only in their mid-40s, so it's not really enough reason. Yvette Cooper is a longer odd shot, according to the bookies. I don't see much chance of this, to be honest, primarily because I think she looks comfortable with the brief in the Home Office. And according to herself, she's doing an okay job. But she isn't, I don't mean that to sound as flippant as it is. There are some measurable results from the Home Office that are superior to the last administration. But they've got a long, long way to go if they want to stave off the reform wave in the next general election. Then Wes Streeting is in there at 8-1, I think simply because he's seen as a bit of a golden boy, and he'd definitely be in a future leadership contest. And remember, aside from anything else, Starmer is 63 this year. My personal view is that he's comfortably, the most right-wing senior politician in this administration. And he might mean some stronger reforms and some pro-business policies. He's the one that would be the best result, but will leave a headache as to who replaces him in health. Let's face it, you can't rule out the fact that Reeves might crack. And I know she's cited personal problems this week as the reason for her breakdown, although I think that might have been a political necessity to calm the markets. It certainly seemed to work. And I think Chancellor is probably a tougher job than Prime Minister. to be honest. Johnny Reynolds has also been mentioned and is the same price at the bookmakers as Wes Streeting is. Now, this is a different kettle altogether. The business secretary with no business experience. He speaks incredibly well, and he's generously described as ideologically flexible, i.e. he'll do what he's told. However, I'm not sure I want Starmer telling him what he wants to do. I think we need a figure who adds value. He's considered to have better relationships with the soft left of the party, so that would be the one positive he would have in Keir Starmer's eyes, I'm sure. Now, and I don't think we can have this conversation without mentioning Torsten Bell. Those might remember when I used to report on him when he was the chief executive of ResF, the Resolution Foundation. He's a more than capable economist, and having watched hours and hours of him on YouTube in the past, he's a clear lefty, typical economist, very smart individual, but he would very much be more redistributive. But politically, he's still very, very new to the game. He'd be a huge gamble, but he would look right in the role. But I'd worry most about the disconnect between his ideology and reality. But if you looked across the country, would he likely bring better outcomes than many of the others? Absolutely. He's one of the very few that's absolutely got the tools to do the job, even if we wouldn't necessarily like what he enacted. There are a couple of other names that need a mention just to deal with the others that are in the bookmakers' eyes, and also probably the one that would concern most of us the most of all, Annalise Dodds, who was the Shadow Chancellor before Starmer took over, the John McDonnell choice, John McDonnell protege. So let's just suffice to say, we'd rather keep her at bay, please. Her politics are too far to the left for a Chancellor, in my view. Douglas Alexander is the only other one in single figures at the betting. But again, I think he's very much more a night watchman style figure. Lots of policy experience. You know, Dodds is definitely the most left wing of all of them. Then the next most left wing would probably be Torsten Bell out of that lot. So, as we've said, Reeves has had the notorious vote of confidence. So everything should be fine, right? Unless, as I said, Starmer himself looks like he's on the way out before he wants to go. The outright favourite in this race, if Starmer did go, is Angela Rayner. Betting markets this week moved to a 22% probability that Starmer leaves office in 2026. And there's currently, according to the markets, more chance of him leaving in 2025 than serving this full term, which is disquieting. I think I probably speak for many when I say the biggest concern, putting aside all of the rhetoric and all the rest of it, the Labour Party are terrible and whatever, as many asset owners who are traditional Conservative voters, possibly Reform voters now, seem to think. I don't really have any time for any of that ideology. I did have concerns, but I was quite convinced that this lot in charge, Starmer's golden boys and girls, if you like, are pretty much to the centre of the party. Poor man's Tony Blair style administration, realistically, which didn't do the country too much harm when it comes to the economic side of things. And Gordon Brown did a reasonable role, apart from when he sold all that gold, of course, which he's well remembered for. But he did preside over a trade surplus. Let's not forget that, apart from anything else. We're a long way away from that these days. So I've always been disquieted by the notion that Labour might get in, Starmer might get voted out or stabbed in the back or whatever, and then a much more left-wing leader would take over who would have much less regard for the things that the country really need them to have regard for. And I think we all know who the outright favourite is there is definitely Angela Rayner. And we don't really and truly know where she truly sits, but I think we've got a very good idea that she's well to the left of Starmer. How far to the left, we don't know. Look, Starmer's certainly ruthless enough to sacrifice Reeves if he had to. You don't get to the top job without that sort of mentality. So whilst I think he sometimes presents as a bit weak, I think that's more his demeanour than a fair reflection of his true appetite to retain power. And the only other name I think that would make it anything other than a penalty kick for Rayner to take over is Wes Streeting, often been touted as a future leader, bound to throw his hat in the ring. And as and when we get there, if they both decide to run, I'll be stunned if they weren't the final two. However, we've all been stunned before in leadership contests, and dark horses do come out of the field. Just a little revision of the process as a segue here. In order to elect a new Labour leader, 20% plus of MPs need to put their heads in the stocks for them. More than 80 people at the moment to force that process. Any candidate needs nominations from 20% of MPs to enter the ballot, and 5% of CLPs, that's the constituency Labour parties, or 3 affiliates representing at least 5% of affiliated members, including 2 trade unions. All party members then get a vote. Party members, registered supporters, and affiliated members. Instant runoff is used. Voters rank candidates by preference, and after preference transfers, the first candidate over 50% wins. So I outline that because it's quite different from the Conservative Party process, which of course we've been much more familiar with over recent years. We're not going to see 8 or 10 or 12 candidates and rounds of voting when it does happen. I'm not really sure there is another significant candidate at this point. So perhaps just a few thoughts over who their chancellor might be, if indeed they do stab Starmer in the back. Rayner would no doubt be more left-wing, as I've said, the darling of the party, and I think the way the voting system works for Labour almost guarantees her victory, in my opinion, if she was going to stand. She's the second most popular Labour figure, only behind Andy Burnham, the Mayor of Greater Manchester, who would need a well-timed soft by-election victory if he was even going to consider the job, and it really isn't clear that he would. Ange is definitely different and would offer a true left-wing alternative, according to the press. Yes, she would. We'd expect economically more welfare, more cost of living relief, more public investment. For that, we need another change in the fiscal rules or an outright breach of the manifesto promises, which, as I've said, is one of those things that needs to happen now anyway. They need to put income tax in, get on with it. It was 32% of the basic rate a few years ago. We can't afford 28%. Lower savings will buffer most of it at the moment anyway. So as in people will save less because they'll be paying more tax apart from anything else. Get on with it, right? It's a key thing to do, even if Reeves stays. And at the same time, you could get rid of employees' national insurance and then make income tax 28, 29%, maybe 30% in a couple of years' time. If that's what you needed to do, that's what you would do, right? And then that would also bring non-working people into the more fair income tax system. Why tax working people more? Employees' national insurance is an utter nonsense. So pensioners wouldn't like that, of course, because they don't pay national insurance. But we need to stop pretending that national insurance only funds pensions or whatever. It's a complete Ponzi scheme at the best of times, as we all know. So it would be a lot easier for Angela Rayner to break the manifesto because she wasn't involved in drafting the economic side as the Prime Minister if she was to take over the party. But who would she get to do all that dirty work in number 11 then? Miliband, since he comes from the soft left, yeah, I know what you're thinking, disaster. I don't think the markets would like that very much at all. Johnny Reynolds, again, hat in the ring, as he's ideologically flexible, as we said. Well, I'd be very, very concerned about the lack of economic savvy between Rayner and Johnny Reynolds. Yvette Cooper, a female double team, possible, would fit the bill of about as right for a lefty as Ange could handle, but would send a good message to the markets. If the markets only make their judgments based on how far right or left a politician is. I think that's mostly true. I think what they're really looking at is how fiscally conservative or not that politician is. But the more close to the centre you are in the Labour Party, the more likely you are to be fiscally conservative. Now, that's not a roll call that's going to cheer anyone up, I don't think. This is why I said this week, be careful what you wish for. One more change in the fiscal rules to support further investment. And perversely enough, the one area which Ange could then define as critical infrastructure would be social housing, which might be one of the best things anyone ever did for the country in the medium term. So sometimes it is strange how these things work out, but it would need to be funded, of course. So don't worry, I'm sure I'd also have plenty to moan about. Sorry, I mean analyse, of course. So that's the worst bit down. I'd say, what about Wes? Third in the pecking order of popularity behind Rayner, as far as Labour politicians go. Openly supports the new Labour pro-business style approach. You'd expect innovation, education reform and growth. Streeting sits alongside Yvette Cooper as the second favourite to be the next Labour leader. But I don't see Cooper as that likely in comparison. What would the message be to number 11? Fiscal responsibility alongside structural reform. Much better for bond yields, I can tell you that. Less welfare, more tax incentives for investment in education and skills, pro-business, pro-market. Doesn't sound all that Labour, does it? And that's the trouble. He'd have to have a Blair-like grip on the party if his moment in the sun really did come. He looks like he's got that potential, but we'd only find out when this hypothetical actually plays out, if it does. So what about Wes's choices for number 11? Well, we'd be back to Pat McFadden and Darren Jones. McFadden with a Blairite outlook would certainly tick the boxes: stability, stewardship, No sudden lurch. Once again, a bit of a continuity style candidate. So don't worry, investors. We're not introducing fresh uncertainty. That would help. Jones would be more of a next generation new ideas sort of candidate. And that really depends on whether Wes would have a very clear idea of the sort of chancellor he would want. One we haven't mentioned yet might be Bridget Phillipson, also a centrist, keen on detail, bringing her passion for education to the second biggest job of all. She'd be an outsider, but she's worth a mention. And for the sake of it, Johnny Reynolds' hat is in the ring, although, of course, he goes to the opening of every political envelope. Maybe think of him as a poor man's Michael Gove would be my assessment so far. And, of course, I'll be really interested in readers' and listeners' thoughts because there's only a summary of my own, and I'm by no means a political analyst. I've just looked at the betting markets and talked about what I know of these candidates. I'm much more concerned about the economic direction and anyone other than a fiscal conservative until we've got a clear growth path and have put shocks to the system behind us will be a bad move for this country, in my view. It hurts everyone by putting the cost of debt up in terms of having less money to spend on government services and in terms of having to pay higher mortgages at the personal level. Even for those who don't own a home, this hurts just as hard or harder. A rental is far more likely to have an interest-only mortgage than a residential property, and a rental always has a premium attached to that mortgage rate versus a homeowner. So you hurt the people you don't want to hurt the most. But if you think, oh, well, we'll build loads of social housing and sort it out, well, that's fine, but that's 10 years away at the very least, even if you had a really strong commitment to deliver 90,000 social homes a year, which we don't have, right? So I'm sure you'll be more on my side after that, though, and be careful what you wish for. As we're at the close, I'd just like to recap on the successful workshop delivery this week. The next one, the bookings are not yet online, but the date is set to Wednesday, October the 1st, 2025 in central London. And that's subject matter, investment metrics, and what's really important, something that the entire industry at the base level and the entry level seems to get wrong year in, year out. And once people have learned it once incorrectly, they don't change their view. What you're going to see is the metrics that Rod and I use ourselves in our businesses. And as I said earlier, we've also got a space at the moment in our boardroom club. We meet once a month to run through your property businesses, challenges, and what stops you from growing. It's a minimum 12-month program, and it kicks off with a deep dive with just Rod, myself, and you to formulate a proper strategic plan for the coming year. If you'd like a no obligation chat about it, please let me know via a comment or a direct message. Above all, please remember to keep calm, always listen to or read the supplement, and carry on. There will be opportunities abound this year and towards 2030. The risks around at this time, while they feel significant, the geopolitical ones, are far less meaningful to the UK housing market than they have been for several years. Of that, I have no doubt. Prices are on the up. Good luck.